Hello and welcome to our daily show where we talk about personal and financial development. And today we're going to be answering your questions about life insurance. There's a lot of confusions about life insurance. There's a lot of questions. There's a lot of misinformation out there. And so we're going to get to the bottom of it. If I can speak today, and we're going to answer your questions. We're going to give you the facts so that you can make the best decision for you, yourself, your family, your business, whoever you got to make decisions for.
Your boyfriend, your girlfriend, your sugar mama, your baby daddy.
All of them.
Everybody can make good decisions when it comes to finances.
So if you don't already know who we are Martin and Chelsea Matthews. We're married. We're in business together. We have a combined 22 years experience in the financial industry. And we're owners of M Wealth Group, financial consulting and investment agency. And we're authors of this book, Let's Fight About Money, helping couples communicate about money, handle conflict, and build an unbreakable financial house, which that is our mission, to help you build an unbreakable financial house so you can handle anything that comes your way and create the life you truly want to live. And today we are talking about, as I said, life insurance. We're asking questions about life insurance. We're going there. So as you come in, please let us know where you're tuning in from. And if you know anyone that has any questions or interest about life insurance, tag them, share this out, like, comment, and share. Also, ask your questions. If you have any questions, Instagram, YouTube, Facebook, wherever else we are, everywhere we are. Put your questions in there. We'll do our best to answer live. And if we don't get to it now while we're live, we will get to it after. So anything else before we dive right in?
Nope, go for it.
All right, so we're going to answer 4 specific questions that we get a lot when it comes to life insurance. And why are we qualified to do this? We have a life insurance agency. So we have lots and lots of experience of helping our clients with many different types of life insurance, which brings me to the very first question that we get a lot. What is the best type of life insurance? And before I answer this question, anytime you ask this question, you want to first look at who is answering the question. Like, if you're asking somebody, maybe a life insurance agent who only sells one type of life insurance, they're going to tell you that's the best kind of life insurance. Everything else sucks. Don't do it. Don't bother. This is the best one. If you're asking somebody who has life insurance, they may tell you the only one that they know, the one that they have. Oh, that's the best one. You don't need anything else. Or somebody who had a very specific thing that they were wanting to accomplish with their policy. So anytime that you have a question that you're getting answered, you want to first look at, where am I getting this information from? Who's answering my question, and what motivation do they have? Okay. And I will tell you before I answer this question, the motivation that we have is, number one, we want to increase people's knowledge about life insurance and other financial topics so that you can be empowered and make the best decision for you, your family, your business, your community. Because the people that we work with, now, if there's a need and a want that we can help you with, of course, we would like to do that. We have a business. But the people that we work with, we want educated, qualified clients who want and need our services, who have a good attitude, and who know what is best for them, because we've helped them to educate themselves to know that. So when it comes to what is the best type of life insurance, it really depends. There's many different types of life insurance, and it really depends on what you're trying to accomplish. There's no bad policy per se, bad type of life insurance per se. It really depends on what you're trying to accomplish. So really quick, I'll tell you, there are 2 main types of life insurance. There's term life insurance, and that lasts for a period of time, usually 10 to 30 years. Okay, it's the cheapest type of life insurance. And basically, it used to be that if you didn't use it, you lose it, right? You had to die to use it. But now there's newer types of term policies that actually can pay you while you're still alive. They have something called living benefits. So if you got hurt or sick and it affected any of your daily activities, you could qualify to get paid while you're still alive. So for example, if somebody got a heart attack, somebody had a stroke, somebody got cancer, it could even be somebody with arthritis. That's one of the biggest payouts in one of the companies that we use is women with arthritis, like in their hands. And nobody dies from arthritis, but it affects your daily activities. If you type on the computer, you dress yourself, you cook, right? All of those things can affect your daily activities. And so you could get paid while you're still alive if one of those things happened. Okay, the other type of life insurance is permanent life insurance. And I'm giving very basic definitions here, just so you kind of have an overall understanding. The other type of life insurance is permanent life insurance, and there's many types of permanent life insurance. And basically, this insurance lasts your entire life, so it costs a little bit more. And there are different types where you can actually build cash in those policies. And Martin's going to talk a little bit more about that in the second question that we answer. But the things that are very important to look at when you're looking at types of life insurance is what the benefits are, right? And some life insurance policies don't have living benefits. When you're looking at term policies, it's very, very, very important to look at a policy with living benefits. Also, not every policy is the same. So if you're going and wanting to get a bunch of different quotes from a bunch of different companies, it's very difficult to compare those policies unless you actually have experience with what to look for. So it's very important to find somebody that you know, you like, and you trust that can help you determine the differences in these different types of policies and what is best for you and your needs. Okay. Is there anything, did I do good, or is there anything you want to add? Okay. So number 2, ready to go to number 2? Any other questions I'm seeing? Stop me if you see any questions. Okay. So that is the answer to what is the best type of life insurance. There really is no best type. There's a best type for you and your needs. Number 2 question that we get asked: how can I use life insurance to buy real estate, or really any kind of
asset? Yeah. So real estate often comes up when it comes to life insurance. So on today's episode, we're answering important life insurance questions. These are questions we get asked all the time. So we thought we'd do a show, answer these questions here, so you have a good general idea about them. Now, how can I use life insurance to buy real estate? First of all, it has to be a certain type of life insurance when it comes to that. Chelsea talked about term life insurance and permanent life insurance. So when people are trying to use it to buy other assets, they're using the cash inside of the life insurance policy, which means it has to be a permanent life insurance policy. It has to be properly designed and properly funded. If it's not structured properly, meaning either the person didn't know what they were doing to design it, or you didn't have the right type of life insurance for that purpose, then it is not going to produce that end result. It has to be two things very important. It has to be properly structured, which means when you're getting the policy, you're designing it, or the agent, the advisor is designing it with that goal in mind. It has to be properly structured and properly funded. So properly structured is dependent upon the insurance advisor. They're the one designing, structuring the plan. Properly funded is dependent on you. You're the one funding the plan. It would be just like if you were building a retirement account and you went to a financial advisor, and they may help you design which funds to be in, but ultimately it is up to you to fund it, because the advisor is not going to fund it for you. Okay, so actually,
that's actually against the law.
we will. There are some life insurance policies that you can finance. We'll get to that, and when we're going to be doing some episodes for high net worth individuals, and what are some of the things the working affluent need. And so we'll talk about some of those kinds of things then.
Red flag: if any life insurance agent ever tells you that they're going to help you fund your policy or give you some kind of kickback or reward or something,
it's illegal.
That's illegal.
It's not legal for them to incite. They're not supposed to incite you to buy life insurance by promising you money.
Now, if it's your kid, you can fund their policy.
Yeah. So, all right. So let me answer the question. How can I use life insurance to buy real estate? One, properly structured, properly funded permanent life insurance policy. It has to be designed to build cash. So when a policy builds cash, there's two components. You have your cash value inside of a permanent policy, and then you have your death benefit. This is an area that can be confusing to people. Think of your life insurance policy, permanent life insurance policy, as a store of value. So we often do a thing where we talk about how to use life insurance like your own bank. So just like you can store money in your bank account, you can store money in an investment account, you can store money inside of a life insurance policy, and it earns interest. Typically higher interest rate than you would get at the bank. That's why people like to use it. So you earn a higher interest rate than you would at the bank. In your cash account, your cash value account or policy, then there's a death benefit. The death benefit, and there's a cash value, there's a death benefit. Sometimes people think they will buy a $1 million life insurance policy and then borrow $500,000 against it the next week. No. You're leveraging your cash in the policy, not the death benefit. Not necessarily, not in that sense. There are ways you design a policy where you can get both the life insurance and the death benefit, the cash in your policy and the death benefit upon your death. Both of those combined can make up your total death benefit. However, what you can borrow against is the cash in your policy. So the idea is, I've got money in my policy earning me interest. I want to buy this real estate deal over here. Let's say this is the real estate. I got this real estate deal I want to buy. I got my death benefit. I got my cash in my policy, right? If I want to go buy this real estate deal, I can withdraw the money. I can withdraw cash from my life insurance policy and go buy this real estate deal, or I can borrow against the cash in my policy. So why would somebody want to borrow against the money in their policy? Very important distinction here. You are not borrowing your money. This is a confusion, another point of confusion that people might have. Or people tell them you're borrowing your money. You're not borrowing your money. Why would anybody borrow their own money? That does not make any sense. You are borrowing, you're using your money as collateral for a loan. Why would you use your money as collateral for a loan? Because you want your money to keep growing in the policy. Again, this is not appropriate for everybody. We're not saying this is what you should do. I'm just explaining how something works so you have an understanding of the mechanics of it, right? So I've got my money in a policy. Why would I borrow against it to buy other assets? Because I can keep my money earning me interest, and I can leverage it to buy an income producing asset like real estate. So an example of people who do this all the time, Elon Musk has an appreciating asset. He owns shares in Tesla. He is not going to just sell his Tesla shares. Why? Because then he would no longer have them. So he is going to borrow against it. There are banks, institutions, all kinds of lenders that would give him a loan against Tesla shares. Why? Because they want to do business with him and to see the value in Tesla shares. So lend him money. He uses Tesla shares as the collateral for the loan. The collateral is something that you pledge or put up to secure your loan, right? So for example, when you get a mortgage on your house, your property is the collateral for the loan, which is why when you default on your loan, your mortgage loan, they take the house from you, to kick you out the house, okay? Because that was the collateral. They now have to seize the collateral. They don't care that it's your home. They seize the collateral from you. They take you out, and now they have to take that property and sell it so they can get their money back. So same with the life insurance policy. What's up, Ellie? So the life insurance policy, you borrow against it, and now depending on the life policy, properly structured and properly funded, your money continues to earn interest. So life insurance company treats it as if no money's left the policy, because technically the money's actually left your policy. So your money stays in the policy, continues to earn interest. You get a loan against it. You didn't take that, you go and buy the real estate. That's how you leverage the policy. So what is the key factor? Well, you have to have money in your policy, which you can use as collateral for the loan. Now, a couple of things on life insurance loans. So life insurance loans, generally the payback schedule, because most loans in America people take, they're like, okay, I got to pay back. How do I pay back? Well, you can control that with a life insurance loan. It doesn't have it generally doesn't have a repayment schedule. Repayment schedule is, I borrow money to buy this property. I got a 30-year mortgage. The 1st or the 15th of next month, I have to start paying it back for the next 30 years. That's a repayment schedule. When I go to buy a car, finance my car, I have to start paying monthly payments on the car. That's a schedule, right? With a life insurance loan, you can take a loan against your policy and not necessarily, you don't have a repayment schedule. Now, why would anybody do that? Why would somebody lend money and not require a repayment schedule? Well, for a couple of reasons. Number one, insurance company knows you have money in your policy because they can see that you have money in your policy. So that's the collateral for the loan. So they do not require a repayment schedule. It's a good idea to pay your loan back, but they do not require a repayment schedule when you take the loan. The second thing is, what's another risk? The first risk is when you take a loan, are you going to pay it back? Well, they know you have money in your policy, so they know you have the ability to pay back because there's money in there. The second thing is that a risk somebody takes when they're lending you money is, what if you die? So you imagine you are a lender, and then you lend somebody money and they die. How are you going to collect your money back? So, well, there's a life insurance policy. Remember, it's a life insurance policy. So there's a death benefit. So if somebody takes a loan against their policy and they never pay the loan back and they die, the death benefit, which is generally far greater than the cash in their policy, the death benefit will end up paying off the loan if it's like greater than what the cash value is or whatever. And the death benefit ends up paying off the loan, and remaining of the money will go to your family. The cash account in your policy will end up paying off the loan, and then your death benefit goes to your family either way. So you can see, when you take a life insurance, when you take a loan against your life insurance policy, there's no qualification, there's no credit checks. They don't check credit because it's not based on your ability to borrow like a traditional loan is. So there's no credit checks. It doesn't show up on your credit report, so it doesn't negatively affect your ability to finance or borrow things elsewhere. So things like that. So it's a loan against your cash in your life insurance policy, which your policy should be properly structured and properly funded. So that is that's kind of a general idea on how you would use a life insurance policy to buy real estate. So we have clients who do this all the time. Our average client puts in $60,000 to $70,000 a year into a life insurance policy. Now, clearly, understand this is not a $20 a month life insurance policy. They're not buying it just because they're afraid they might die tomorrow. We're talking about permanent life insurance policy in this case. We own both term and permanent life insurance. I don't have a bias towards one or the other. We use them for different purposes. Like Chelsea mentioned, term is cheaper. It's the cheapest type of life insurance you can get. So if you're on a budget and you want to protect your family in case you die or in case you get critically sick or hurt, you get a term policy. That's the cheapest type of life insurance you can get. If you're trying to store money inside of this vehicle and you're like, I like the concept, I want to store money inside of a vehicle where I can get a greater return, greater than the interest rate I would get at the bank, especially due to inflation, and I want to be able to leverage it for income producing assets, then you may want to consider also a permanent policy. To give you perspective, like I said, our average client puts in $60,000 to $70,000 a year. So they're not doing it just to buy life insurance. They're storing money inside of policies and they're leveraging it for assets. So they frequently borrow against their policy to go buy real estate. That's how they do it. So sometimes people ask, hey, is there a minimum? There's not necessarily a minimum with life insurance. Our company, we have minimums based on the history that we like to see people financially in a position to be able to do. So look, if you can't put away comfortably $6,000 a year into a policy like that, you're probably not ready to do it. You probably shouldn't do it. You should probably get your finances in order, be financially in a position where you can put a minimum, that's a minimum. Our clients put 10, 15 times that. We got clients who put $250,000 a year inside of a life insurance policy. So again, this is because, how much real estate are you going to buy if you're only saving $6,000 a year? It's going to take you forever to build up enough capital to go buy real estate. So that's kind of how to think about this.
And also, if you're not ready for that type of a policy, you can start, if you don't have any coverage at all, you can start with a term policy. One thing I forgot to mention is some term policies, you can convert them into permanent policies. So you get started with some coverage, get some coverage in place, and then, you can convert it when you're ready to start funding it at a higher level. Okay. So we're talking,
Oh, sorry, I wouldn't say you can go to the next question, but yeah, you can go.
Oh, thank you for permission. We're answering life insurance questions today, and we answered what's the best type of life insurance, how can I use life insurance to buy real estate, and number 3 question is, can I put life insurance into a trust? We get this question a lot about trusts.
So people are fascinated with trusts.
They're cool.
They're cool. They're useful. There's first of all, there's not just one type of trust. There's many different types of trust. There's charitable trust, life insurance trust, dynasty trust, a special needs trust. If you have special needs children, you want to make sure they're protected. All kinds of different things.
Sugar baby
there's
trust.
incentive trust, sugar baby trust. That was popular in Vegas. Sugar baby trust. So no.
That's not a real trust.
There are times where it's appropriate, and there's times where it's redundant. So the reason why people will have assets in a trust is one, because a trust bypasses the probate process. Probate is when somebody dies. You got to go to court with all the documents. Court assesses their affairs and help determine how funds should be distributed from their estate. Right. So that's the probate process. You go in there and you probate the will, it's called. And then the other thing would be, people may have minor children, and children can inherit. Are you going to leave an 8-year-old $2 million of life insurance? No, they can't receive $2 million. They can't even open a bank account. So as a result, they may put the trust as the beneficiary, and then they will list what they want, how they want those funds to be used, and then somebody executes, their wishes if they passed away while they have minor children. Because life insurance bypasses probate anyway, there's usually, outside of those kind of initial reasons I listed, there's not for the average person, there's not a big reason for them to put the life insurance policy into a trust, because the trust life insurance bypasses probate and pays directly to your beneficiaries anyway. You don't have to go through the probate process when life insurance. You name your beneficiary, and that's who it's paid to. You can have multiple beneficiaries. You can say, I want 10% of this person, 20% of this person, and 15% of this person, and all of that. And the life insurance company would distribute those checks to those people, how you name them as your beneficiary. So that's all handled on a life insurance front. There are 1 or 2 other reasons why life insurance is put in a trust. Is if you have if you're a very high net worth person worth over $20 million, the life insurance policy can count towards your overall estate, and you could be hit with estate taxes, not from the life insurance policy. Life insurance policy, death benefit is not taxed, but the total amount plus your other assets could put you above the estate tax threshold. If you don't know what estate taxes are, or this is foreign to you, most likely it's not going to apply to you. If you are above a $20 million net worth, then you may want to start looking at an irrevocable life insurance trust, in which the trust purchases life insurance on you, and then upon your death, the trust is paid the life insurance proceeds, and then the trust pays the estate taxes. So we had a client where he was facing a big estate tax bill if he died. And so he didn't have sufficient life insurance, so a trust was put into place, irrevocable life insurance trust, where upon his death, money will be paid into the trust. The trust will pay the estate taxes, which his family would not have to sell his business or his real estate assets in order to pay the estate taxes upon his death. So very important thing. If you're not around $20 million, you probably don't need an irrevocable life insurance trust for that particular purpose. So it's somewhat redundant to have life insurance policy in the trust, unless you have minor children you want to make sure they're covered, or you just want to put life insurance into a trust because you think it's cool. Otherwise, there's not a whole lot of functional reasons, because life insurance by itself already avoids probate, and it can go directly to your beneficiaries. Unless you want to control the distribution somehow through a trust mechanism, then that's fine to do. Okay.
All right. So number 4 question, we're answering questions about life insurance. And number 4 question is, can I buy insurance on my parents? The answer is yes. You can buy life insurance. Well, almost on anyone. They have to know about it.
And they have
but
to get permission.
Yeah, they have to know about it. They have to be in agreement with it. But this is an excellent way to create your own inheritance. So if your parents don't have life insurance, now here's the thing to consider is that the older that somebody is, some of the things that go into the cost of life insurance is age, health, some other factors. And so as somebody gets older and maybe has more health issues, then the cost gets higher, and sometimes it could get more difficult to get approved. We get people approved all the time with different health conditions, different ages. So really, you just have to kind of reach out and, we can, if you have a question on, can I get my parents or can I get me or somebody approved, we're happy to look at the circumstances and let you know. But we're able to get a lot of people approved for a lot in a lot of different situations. But yes, you can create your own inheritance. If your parents don't have life insurance, aren't leaving you a big trust fund, not leaving you a big estate, you can actually create your own inheritance. And for one, it can also, if they're able to get the policy with living benefits, that can be a huge help because if they need any kind of assisted living, if they need help with their daily activities, they have something develop, then that's something that's very important to have in place. But you can absolutely create your own inheritance for a fraction of, basically pennies on the dollar. We have one of our clients, as an example, has policies on himself, on his wife, his ex-wife, kids, parents, and then his kids even have policies on them, on the parents. They have their own policies. They have policies on their parents. So everybody has life insurance on everybody. And
they've created a pool of millions and millions of dollars. Using that strategy.
Yeah. So no matter what happens, they can handle the unexpected. And then also, this is really how you create generational wealth. Okay. When you talk about creating wealth for generations and creating a legacy and, helping the next generation get ahead, this is really how you do it. And life insurance is one of the ways that really help the rich get richer and the poor get poorer, because typically wealthy families have a lot of life insurance. And so when somebody passes away, they have millions of dollars pour into that family. And typically people who are lower income, people that don't have a lot of wealth, they may not have life insurance. They may think that they can't afford it. That's one of the things that people overestimate. They think life insurance costs like 4 times more than it actually does. And then, or they think that they don't have any reason to have life insurance because they don't have a lot of money. So then what happens when a family member dies in a lower income family is they get poorer. Then maybe that was an income earner. They lose that income, and then everyone has to pull together, and then they're in a worse financial situation. So if literally every family had life insurance, families could be getting wealthier and wealthier and wealthier by generations. So it's really something to look at. If you don't have any life insurance in place at all, you can reach out for free. You can get a quote for life insurance. You can go to 6buildingblocks.com/quote. 6buildingblocks.com/quote.
And with the number numerical 6. So put it on here.
Yeah. And if you have any questions about, can I get approved? Can I get coverage on this person? Should I have a trust? If you have any additional questions about life insurance, please feel free to reach out, and we're happy to help.
Yeah. So, and I also have a life insurance policy with my mom. So I want my mom to live a long time. My father died. He didn't leave me inheritance. I didn't necessarily need for him to leave me, but would it have been easier? Would it have made things easier? When my dad died, I think I was in my early 20s. So would it have made certain things easier or for me? There's a lot of people you see who are able to start businesses that didn't have the capital, but their grandparent left them something and now they got the capital and were able to start that business. So you often don't see the origin story of some of these things, but a lot of times that's how it happens.
Master P.
Yeah, Master P, his grandfather had an insurance policy that helped provide some capital to him, and he did some other things to get things going. So there's tons of people who are started businesses, and you don't see it because people don't always make it public. Like people don't tell you to just received inheritance through life insurance. They don't tell you that. And they don't advertise it on social media. They don't say any of that stuff because a lot of times they don't want you to know. If you inherited $2 million, would you, maybe you might, but would you go and be flashing, hey, look, I just received this $2 million inheritance? You probably wouldn't. You probably start looking strategically about, okay, what do I need to do? How do I need to go strategize, and how can I make things happen?
But something that's really important, if you do have a life insurance policy, make sure your beneficiaries know.
Yes.
Because they're not just automatically notified. And a lot of times people could have life insurance and they don't even know that they're a beneficiary of somebody's policy. So please let your beneficiaries know.
Yes. All right. So we'll be back tomorrow. We're here Monday through Fridays, 9:30 a.m. Eastern time. Where we talk about personal development, financial development. We talk about different financial topics so you can get your mind right, to get your money right, and keep advancing. Especially if you're a business owner, tune in. We're going to be doing some episodes for affluent individuals, because affluent individuals have different needs than the average family, the average household. We're going to talk about different types of trusts. How do you finance a life insurance policy? How do you do strategically do different things as an affluent individual? So we'll be talking about those things coming up. So stay tuned. Make sure to subscribe to our YouTube channel, and we'll see you guys tomorrow.
Bye.